Welcome to This Explainer. I am absolutely thrilled you're joining us today because we're going to break down the share market completely from scratch. If you've ever felt like the financial world is just speaking a totally different language, well, you're in exactly the right place. Let's get right into it.
So, have you ever turned on the TV and seen those wild headlines? The stock market crashing. Or maybe those legendary stories about overnight millionaires like Harshad Mehta? It can honestly seem like this chaotic, super intimidating world just full of flashing red and green numbers. But I promise you, by the end of this explainer, we're going to completely demystify exactly how this market actually works. We're going to keep it simple, structured, and super easy to understand.
We're going to build your knowledge step by step. First up, what are shares exactly? Second, 3 ways you make money. Third, inside the stock exchange. Fourth, tracking market ups and downs. And finally, choosing your trading strategy.
Part 1. What are shares exactly?
To really wrap our heads around the massive stock market, we first need to understand a single, individual share. Let's look at a totally relatable example. Imagine a businessman. Let's call him Mr. Sharma. Mr. Sharma has this incredibly successful business, and it's valued at 100 crores. The market absolutely loves his products, and he wants to expand. He wants to launch new ones. But to do that, he needs 50 crores in funding. Now, he could go out and look for a single super wealthy financer, right? But there's a second option. He can divide his company's valuation into tiny little parts and sell a portion of it to the public. If he sells 1 crore of these small parts or shares to the public at 50 rupees each, boom, that transaction gets him the exact 50 crores he needs to expand.
The absolute crucial point here is this: shares are units of ownership in a company. What does the public actually get for their 50 rupees? Well, they aren't just making a donation. They get a real, actual stake in the company. If you happen to buy enough shares to equal 5% of the total issued, you literally become a 5% owner in Mr. Sharma's business. It is a direct unit of ownership.
Moving on to Part 2, 3 ways you make money. Now, you might be wondering, if you own 5% of the company, do you just automatically get 5% of their direct profit magically sent to your bank account? The short answer is no. But there are 3 distinct ways you do profit. The first is what most of us naturally think of: selling at a higher price. Say you buy Mr. Sharma's share at 50 rupees. His company expands, it crushes it, and suddenly everyone wants those shares, pushing the value up to 80 rupees. You sell at 80 and you pocket the difference. The second way is earning quarterly dividends. You see, every quarter, companies declare their profit or loss. If they're in the green, they might decide to distribute a portion of those profits straight to shareholders as a cash dividend, or maybe an asset. It's basically a reward to attract and keep investors, though keep in mind, not every single company offers them.
And that brings us to the third, honestly fantastic way to make money: receiving bonus shares. Depending on your current holdings, a company might just announce a bonus issue ratio. Let's say the ratio is 1-to-1, and you're currently holding 100 shares. The company literally issues you an additional 100 shares, completely for free. It's like a buy one, get one free deal, but for stocks.
Part 3. Inside the stock exchange. Okay, so we know what shares are, but where are these units of ownership actually bought and sold? Well, think about buying a brand new Godrej sofa. Do you drive directly to the massive Godrej manufacturing plant? No way, right? You go to a local furniture store in the market. The exact same logic applies here. When you want to buy a share in a company, you definitely don't go knocking on Mr. Sharma's office door. You go to a stock exchange. The stock exchange basically acts as the established central store where all this buying and selling takes place.
Let's walk through the actual, literal procedure of what happens the moment you hit buy. Step 1, you place a buy order with your stockbroker. Step 2, that broker acts as your personal agent and passes your order directly to the stock exchange. And just a quick side note, there are currently 7 recognized exchanges in India, with the Bombay Stock Exchange and the National Stock Exchange being the absolute biggest ones. Step 3, the exchange's systems instantly search for a matching sell order. And Step 4, a price is locked in between the buyer and the seller and the transaction is confirmed. Your broker will charge a small commission fee for facilitating this, but the absolute most mind-blowing part? This entire 4-step matching service happens in literally seconds.
Part 4. Tracking market ups and downs.
Because thousands of transactions are happening every single second, we need a way to understand why prices fluctuate so wildly. Ultimately, it all comes down to basic economics. When the demand for a share is greater than the available supply, meaning everyone wants to buy and literally no one wants to sell, the price rises. Simple as that. Conversely, when demand is less than supply, the price falls. Stock exchanges use these incredibly sophisticated algorithms that track current prices and trading volumes to adjust these numbers lightning fast.
But with prices changing that incredibly fast across multiple public companies, how do we actually know if the overall market is having a good day or a bad day? Well, we use an index. An index is simply a measure representing the overall performance of stocks in a specific segment. So, you could have an index tracking the technology sector, energy, or even transportation.
A perfect example of this is the number 30. When you hear news anchors shouting on TV about the Sensex crashing or soaring, they're talking about the Bombay Stock Exchange's oldest index. The Sensex basically takes the top 30 largest, most actively traded companies in India and groups them together. This gives us one single, super easy-to-read number.
And just to quickly add to that, the Nifty 50 works the exact same way for the National Stock Exchange. Just instead of 30, it tracks the top 50 companies. By just glancing at these index numbers, we get an immediate, highly accurate snapshot of the entire market's overall health.
Part 5. Choosing your trading strategy. So, now that we've got the big picture down, how can you actually participate? Well, it all comes down to your trading strategy. Let's look at a day in the life of someone using an intraday or day trading strategy. 6 a.m. They're awake doing pre-market analysis, checking overnight developments and global news. 9:15 a.m. The market opens and the sprint begins. They are constantly monitoring technical analysis, hunting for entry and exit points. 4 p.m. The session closes, and by 6 p.m., they're already doing a post-market review. In day trading, you are buying and selling stocks on the exact same day. It requires incredible discipline, split-second decisions, and heavy technical expertise, because you are trying to profit off tiny, super short-term price movements.
Now, in stark contrast to that frantic, high-stress pace of intraday trading, or its even faster cousin, scalping, which happens in mere seconds or minutes, we have position trading. This is where you purchase stocks and you hold them for months, or maybe even years. Position traders completely ignore the daily noise and those hourly fluctuations. Instead, they focus purely on long-term trends and the fundamental underlying value of a company over time. It's a completely different mindset.
Which brings us to our final and maybe most important question. Which strategy actually fits your lifestyle? Are you an adrenaline-driven day trader, or are you more of a patient, calculated position trader? There's absolutely no wrong answer, but your choice will dictate your financial future. We're going to build on these foundations and start analyzing real charts in our next explainer, so until then, keep learning and keep investing.